Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. Before we welcome Dimitri to the stage, one last look at the disclaimer, and Dimitri will come on and talk about call spread evaluation. So let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Let me share your screen, and there we go.
Good morning, everyone. And I think we'll continue on our conversation from yesterday. We set up a call spread, and then we started to look at different ways to research it, analyze it, evaluate it. We stopped halfway, so I'm going to continue on that conversation. Let's go to Google, set it up, and then discuss how we could look at a call spread. And before we make any type of decisions, different ways we could analyze that call spread. So I typed in Google in the search box. We land on the summary page. On the left-hand side, we have a menu. Let's go to the options. We're going to click on option chain. This will take us to the Google option chain. I'm going to click on this menu to minimize it, expand our screen. And a quick recap was yesterday we were talking about, well, if we're looking at an option chain, like here, Google, and we have all these different options and option prices. Well, how do we take those option prices or different options or strategies and run analytics and get more insights before making any type of decisions? So let's set up a call spread. In Google, we're on the August 29th expiration. Let's click on the 210 call. So I'm going to click on the offer here. This is the calls, the bid and offer. When you click on that ask price, you see a ticket come up, buying August 29th, 210 call for 345 because that's the displayed price. And then in a call spread, it's a strategy. You're buying one call on one strike, selling another call on a different strike in the same expiration. We're going to create a bull call spread. So let's go up to a higher strike and click on the bid. So that's the 155 bid. And now you see the second leg of that call spread, selling the August 29th 215 call for $1.55. If you could go in there and change any of these parameters, it just auto populates for you when you click on it, based on, if you're clicking on the offer, it looks at buying it on the offer or ask price. If you click on a bid, it populates that option as a sell on the bid display price. So now that we have this spread, what we want to do is run an analysis and get some insights, just like if you're making any type of investment. Either we talked about rental properties or you're buying a business or any type of investment. Well, here's what we define what the trade is, the investment, and we see the market prices, then we want to go and analyze it further. So I'm going to run this analysis, and it will come up with some initial analytics for us to look at. And of course, we could go in deeper after that, but this is our initial analytics. We discussed about yesterday looking at a valuation of the spread using two different methodologies. We talked about the current market where we see the bid and the offer in the midpoint. We stopped there. And another thing to look at is the risk sensitivities of your spread. So now we have the strategy. It costs us $1.90. It's a bull call spread. And this spread has different sensitivities. We call them Greeks to changes in the market, right? So it has a positive delta, meaning that it's a call spread, so it's bullish. Positive delta means, if the stock goes up, then it's expected to gain in value. If the stock goes down, it's expected to lose in value. If it's unhedged, it has a gamma, vega, theta, and rho risk. I won't get into the what delta, gamma, vega is in this session. We've done it before, but these are your risk sensitivities to different changes in parameters for this spread. Another thing we could look at is the price chart. How did this particular spread change throughout the day? So this is a daily chart. It plots the spread value. And when we look at the chart, and we think about the option prices, the option values change based on different factors, and not necessarily because something traded, like a stock. When we look at a stock price, these are actual trades, transactions. So when we see 209.16, well, that's based on a trade. Okay, so that was a transaction that occurred, and that's where the price is coming from. But option values change because they update their derivatives. So they update based on other factors, like when the stock price moves, well, the bids and offers are changing. The market makers are moving their bids and offers because it's a derivative and other things are changing in the marketplace. So it could be implied volatility, it could be stock moves, but those option prices will fluctuate. And to track the value of that spread, we take the market display bids and offers at different stages, and we use those as reference price. So instead of trades, what we do is look at what the current bid and offer is, and we could use the midpoint as that moment where at that moment was the fair value. And by capturing that, we could see how the values changed over time throughout the day. Okay, so that's what this is looking at, is how the market value changed throughout the day. So we could see that this line is showing us that this is a pretty volatile strategy, in the sense that it moves around. It's not one flat line where it stayed the same all day. It looks like throughout the course of the day it increased in value, but it doesn't stay at the same spot. So we could see here that if we're tracking the midpoint, we see that the high of the day is $2.21. The low was $1.32. The median price was $1.93 and the average was $1.93. So you could see that even around the median price, it got, pretty far away. It started at $1.44. So that was our first observation. And at the end of the day, the midpoint was $1.84. So on the day, from the opening to the close, it was up 40 cents. Okay, so that's how that spread increased on the day. So that's not looking from the previous day's close. That's looking from the initial value from the morning to the end of the day. A bid-ask spread is how wide the difference is between the bid and the offer. And that's important because it measures liquidity, right? Because if you're looking at any type of transaction, you want to know the liquidity. What is the cost of getting in and out of the spread based on the display prices? The wider they are, that means the less liquid, and the costlier it could be to get a trade execution. So it's been as wide as 26 cents in the high end, the low 5 cents, the median 13 cents, average 12 cents. So we get a sense of how wide the spread is between the bid and offer. So you can see it started out in the morning 26 cents wide, and at the end it was 13 cents wide, which kind of indicates in the morning it starts wider, and then and typically that's what happens as trading occurs and more people put in bids and offers, that spread tightens up. Another thing what this tool does is detect if this particular trade call spread traded on the day. Okay, so this scans the trade, the scans for multi-leg trades, sees if this particular trade occurred throughout the day, and then it shows us the trade summary. So here it says that there are a total of 32 trades in this call spread, particularly, multi-leg trades where these two legs were involved, for a total volume of 432 options. Okay, so you could have a certain amount of trades, and the volume would be larger because you could have one trade that involves only, one or two contracts. You could have one trade that involves 500 contracts. So 32 times we saw the trade for a total volume of 432 options. The VWAP price of the trade was $1.95. So throughout the day, volume weighted average price was $1.95, with the VWAP bid and offer at the time $1.91 to $2. So what this helps us do is see where this particular spread was executed relative to the bid and offer, which looks like right around the midpoint of the bid and offer. That's important information because it lets us know that, hey, if we're looking at the spread, we've seen it trade throughout the day, and there is a good chance based on the transactions that you could get executed or filled near the midpoint of the bid and offer. So when you're placing your bid and offer, that's good information because now you know that there is already a history of getting executed between the bid and offer, and you could save a lot in transaction costs. If you know that information and you're able to get that execution. Really quickly, I'm going to just do this last payout diagram. This is what the spread looks like at expiration. So this is the anticipated payout diagram. You can see it's a bull spread. So as the stock goes higher, you're expected to profit in this range. And if the stock goes lower, that's your expected loss in that range. And this gives us some summary statistics. Here's the current price. For break even, we need it to go to $211.90, because if we're buying it for $1.90, we need it to be $1.90 above the 210 strike, which means our break even is 1.2% away from the current spot. We need it to increase at least by 1.2% to hit our break even at expiration. Our max gain is achieved if the stock goes above 215, right? Which means it has to increase by 2.7% or more to get our max gain, hit our max gain. So if we're paying $1.90, and our max gain is $3.10 because above 215, the spread is worth $5. So if we're risking $1.90 to potentially make $3.10, our max gain is 163%. Right? If you invest $1.90 and if it goes to $5, that's 163% return on the amount you have at risk. Okay. And if the stock stays flat, like if at expiration we're at the same price, well, you would lose 100% of that debit, what you paid $1.90, because this spread would be out of the money, right? The stock right now is at 209.31, which is below the 210 strike. So if it stays there, then you would lose 100% of the value. So, Will, I'm going to stop there and throw it back to you.
AD, thanks for bringing this to the Chameleon community again. These webinars are a great resource to everyone who watches them. Thanks so much, my friend.
Thanks, everyone, for joining. Stay safe out there. We hope to see you guys tomorrow.
See you tomorrow, D. Thanks so much for bringing this to everyone. Bye.
Bye.
Hey, everyone. Thanks for checking into today's show. All the regulars, much appreciated. Rob, seeing you popped in late. You may want to watch it on rerun. For those who are here for the first time, remember there's a 7-day free trial. Just click on MarketChameleon.com and go to the trial page, and there's a 7-day free trial there. Everyone, again, thanks for joining. Thumbs up on all the social platforms, particularly YouTube if you're watching it there. Always helpful. Thanks so much, everyone, and we'll see you tomorrow. Bye.